Good evening members, Namaste. I welcome you all for this study circle meeting on the topic Regulatory Framework for Related Party Transaction and Insight under the Companies Act 2013. To deliberate upon this topic, we have with us CS Sajjan Kumar with us. I may call upon Chairman of Bangalore Branch, CA Manjunath Hallur sir, to escort the speaker onto dais and welcome him with the floral bouquet. Thank you, Chairman sir. I have privilege in introducing CS Vijay Kumar Sajjan. CS Vijay Kumar Sajjan is a seasoned company secretary and fellow member of the Institute of Company Secretaries of India with over 15 years of pre and post qualification experience in corporate law, finance, audit, taxation and advisory services. He holds a bachelor in business management and has cleared his Group 1 of CA final examination. Mr. Sajjan has built a robust professional practice in Bangalore, catering to over 315 companies, including multinational corporation, public sector undertaking, business across advisory sectors such as FMCG, manufacturing, healthcare, software, mining, NBFCs, real estate, hospitality, agriculture, smart city, SPVs. He has successfully facilitated the incorporation of over 150 companies and LLP across various Indian states. He has held key leadership role in Bangalore chapter of ICSI from 2015 to 2022, including chairman, vice chairman, secretary, treasurer, respected thought leaders and educator. Mr. Sajjan is a regular faculty member at ICSI and ICAI, contributing to academic and professional discourse through lectures, seminars and published articles on the Companies Act 2013. He has also served as a vice chairman and ongoing member of the corporate law committee of the FKCCI. Beyond his corporate engagement, he serves as an independent director at Leapfrog Engineering Services Limited and contributes to the educational advancement as a member of the advisory board of Sri Sharada International Schools and PU College in North Karnataka. Previously, he has held finance and audit role at reputed firms including Gaura Agro Private Limited, Brahma and Company, Vijay Panchappa and Company. He has recognized by the Deputy Chief Minister of Karnataka, Shri B.S. Yedurappa sir, for securing the highest score in the company law during the CA intermediate examination. Mr. Sajjan contributes to be a trusted advisor in corporate law and governance, leading a respected independent practice from Sheshadripuram, Bangalore. With this brief introduction, I present before you CS Vijay Kumar Sajjan. Over to you, sir.
Okay. Chairman and other office bearers, for inviting me to deal on this subject on arbitration related matters under Provisions of Companies Act 2013. I thank you wholeheartedly for inviting me and giving me opportunity to deal with this topic. Chartered accountants or company secretaries or cost accountants, all professionals requires transparency and fairness in all the transactions. The transparency and fairness, if it is not there, then there is a benefit of doubt, or there is a lacuna, or there is some mismatch in the provisions of the Companies Act or in the affairs of the company. I think motto or logo of the ICI is partner in nation building. If a transparency fairness is there, then we are partner in nation building. So as a professionals, as a chartered accountant, as a company secretary, as a cost accountant, we should know the related party transaction to ensure transparency and disclosure requirement. To deal in detail about this topic, we can start with this regulatory framework under Companies Act 2013 on related party transactions. I am covering only related party transactions under Companies Act. I am not going to deal with SEBI related, LODR related provisions because it is a vast. Within 2 hours, it is very difficult to cover. And being a chartered accountants or domain experts, I am not going to cover accounting standard number 18 and Ind AS related matters, because you are the domain experts, I am a company secretary. So you are the better person to deal with this expertise subject. So let us deal with this only Companies Act related provisions under Companies Act 2013 with respect to related party transactions. These are all disclaimers. This only, I am not going to give any professional advice or opinion. It is only academic purpose. I am going to deal with some of the intricacies or some of the interpretational issues in the Companies Act 2013. Why it is relevant or important for chartered accountants? Related to the transactions, RPT, why it is important? Because CAR 2020 requires chartered accountants to report or disclose whether related party transactions are in compliance with accounting standard, in compliance with Companies Act 2013 section 188, you have to report. So for that compliances, if you want to check, you have to know what is the content of this RPT. Then Companies Act 2013 Schedule 3 requires RPT related disclosures in the notes of accounts. Then there are some provisions after, we will deal later what and all it is covered under RPT related provisions. Then accounting standard number 18 and 24 talks about related party transactions. Auditing standard SA 550 talks about related party transactions. Then internal auditing standards are there. Internal auditing standards 18 talks about related party transactions. This SA is mandatory now for chartered accountants. Earlier, prior to Companies Act 2013, it was not mandatory for chartered accountants. Only institute mandates compliance of auditing standards. Now 143 section talks about mandatory compliance of auditing standards for chartered accountants. Then Income Tax Act 48 talks about excessive payments to related party. Then due diligence report in case of consortium lending more than 5 crore, every 6 months every company has to take a due diligence report. In the due diligence report also there is a provision for related party compliance, whether compliant or not. Every chartered accountant or company secretary, whoever is issuing the due diligence report, has to report that whether RPT is in compliance with 2013 Act or not. They have to comply while issuing the due diligence report. For this reason, chartered accountant or professionals is required to know RPT provisions under Companies Act 2013. So, CAR 2020 clause number 13 requires all transactions with related party are in compliance with 177 and 188 of the Companies Act wherever applicable, and details have been disclosed in the financial statement as required by applicable accounting standards. So, chartered accountant has to report this CAR as part of the statutory audit report of every company in India. So, this is the requirement why we are today to deal with this related party transaction. And another one related to the transaction, clause number 15 of the CAR report, all non-cash transactions, whether in compliance with section 182 or not in compliance with 182, every chartered accountant has to report wherever CAR is applicable for certain companies. So because of this reason, we have to know, you have to understand what is the 192 section, how it is related, what are all the linked sections are there with regard to 192, we have to deal with this. There are two major provisions dealing with related party transactions. One is 188, read with relevant rule number 15. Another one, section 177, read with rule number 6A of the Meetings and Board Power Rules 2014. These are the two main governing provisions under Companies Act 2013 with regard to RPT related provisions. Why we have to monitor RPT? As I told you, transparency is required. There is no prohibition for related party transaction. Only thing is it should be regulated. There should be transparency. There should be approval requirement as per Provisions of Companies Act. These are all the why you have to monitor the RPT. Transparency is required. Shuffling of the fund, diversion of the fund is maybe there or may not be there. We have to check as per the relevant provisions of the Companies Act, relevant accounting standard, and SEBI allowed here in case of listed companies. This is the section 188 talks about related party. Subsection 1 talks about no company shall not enter into contract or arrangement with 7 transactions. So these 7 transactions are there. We will deal with one by one 7 transactions later on. So if it is 7 transactions are there, if it is a falling under with 7 transactions, there are some threshold limits are there. Within the threshold limit, board approval is sufficient. No need to go for shareholders approval. If it is a beyond threshold limit, the board approval as well as shareholders approval is required mandatorily. Under old law section 297 talks about central government approval. Under old law we used to go to regional director Hyderabad for our region. We used to get a approval for each and every related party transaction under old law. Now there is no requirement of central government approval. It is only self-regulated by the company. So it is only self-regulated. There is no requirement of central government approval as required under old law section 297 of the Companies Act 1956. So within threshold limit, it is a board approval. Above threshold limit, it is a prior approval of the board and shareholders as the case will be based on the threshold limits. What is that survey transaction? When it is prior approval, when it is prior approval of both, we will deal one by one with this. Subsection 188, subsection 1 talks about board approval. When it is board approval, it says except consent of board of directors given by resolution at a meeting of the board subject to conditions as will be prescribed, no company shall enter into contract or arrangement with related party with respect to 7 transactions are there. So it does not talk about subsection 1, does not talk about whether it is a board approval is prior approval or post approval, does not talk about prior or post approval. With this interpretation, you can assume that it is a prior approval because the word says except entered into. Enter means you have to execute some contract. Without execution, company cannot enter any transaction. And it is a word shall is there because of shall. So all these wordings you can conclude the combined reading. You can conclude that it is a prior approval of the board. There is no post approval of the board. And the word shall is there. It is a mandatory for every company in order to transaction with related party. They have to take a prior approval of the board of directors of the company with this combined reading. But whereas in case of above threshold limit, you have to take a shareholders approval. The shareholders approval is prior approval. Going by this word, all related party transactions you have to get an approval by UFA at the meeting, not by UFA circular resolution, because the wording is subject to conditions as will be prescribed at the meeting of the board. So you cannot, RPT related transactions, you cannot pass by a circular resolution, it should be passed at the meeting. Whereas in case of related party transactions at the audit committee, you can pass this resolution by a circular also under section 177. And the word is company. Company includes both private company, public company, all types of companies are included in this RPT. And it is mandatory for every company to take a prior approval of the board in case of RPT related transactions. Circular resolution is not possible under 177, under 188, but whereas under 177 it is circular is also possible, including omnibus approval. It is possible. What is company? What is board of directors? There are some separate sections are there. We have noted down those sections. The heading of the section is related party transactions, but everywhere inside the transaction he is using the word contract or arrangement. Only in 1 or 2 places he is using the word transactions, but our majority sections they is using the word contract or arrangement. Or then is there any difference between contract or arrangement or the transactions? So there is no difference. It is one and same only as per my opinion. There is no difference between contract, arrangement or transactions. It is one and same only. When this 188 is applicable, there should be company, there should be, the transaction should fall with 7 transactions and they should transact with related party. All 3 conditions should be complied in order to get a 188 compliance. There should be company, 7 transactions and related party. Related party, who is the related party? We will deal with separately under 2 subsection 76. If anything is missing in these 3 conditions, then 188 is not applicable. You need not report in the Caro report. These are all the 7 transactions. First transaction is sale, purchase, supply of any goods or materials. There is no definition for goods, whether share is included, whether securities are included. There is no clarity under Companies Act 130. You have to dwell upon our neighbor house Sale of Goods Act. Sale of Goods Act says goods includes shares, actionable claims. So in case of transfer of shares between related parties, wherever company is involved, then it requires prior approval of the board. Because goods includes share includes goods. I think sale of goods and the GST Act also talks about goods. Goods includes share also. I think its exclusion is there. It includes share also under GST Act also. Whether securities, other debentures or other securities are covered within the definition of goods, there is no clarity. Whether it is covered or not, there is no clarity. Whether in case of sale of debenture or transfer of debenture, whether it is falling within the definition of goods or not, there is no clarity. As per my opinion, we need not consider within the definition of goods because Sale of Goods Act clearly states that only shares and actionable claims are covered. does not cover any other things. Then, in case of allotment of shares, whether considered as a goods, whether allotment of shares by a holding company to subsidiary company requires compliance of section 188, or in case of transmission of shares, transfer of shares, whether gift of shares, whether it requires compliance of 188. So there are some doubts are there among the professionals. In case of subscription, in case of subscription to the MO and AO, in case of incorporation, whether it is considered as a related party transactions, whether it is considered within this definition of goods, there are still some interpretation issues are there. Or whether allotment of shares to related party is a related party transaction under 188, whether 177 approval is required along with 188, or only 188 is approval is required. 177 talks about audit committee. Audit committee mandatory in every specified company needs to be constituted only for a specified company. Private company is not mandatory. Only specified unlisted company, listed company is mandatory. All these interpretation issues are there. If any answer is there, you can tell me. Otherwise, I will discuss, because it should not be one-way traffic. It should be two-way traffic in order to get some interest in the subject. First question: whether allotment of share is a goods, whether it is considered as a goods and requires compliance of 188 of the Companies Act 230. Yes. Allotment of shares. Allotment of shares cannot be considered as a goods, because only after allotment it will give a character of goods. But the date of birth of that particular product is only after allotment. Before allotment, it is not considered as a goods only, because it is not a goods prior to allotment. The character of shares will come into picture only after allotment. So in case of allotment of shares, so holding company to subsidiary company or related party is considered, it is not considered as a related party transaction, because it is not considered as a goods. In case of transmission of shares, or in case of transmission of shares, it is not considered as a goods, because for as per Sale of Goods Act, there are 4 or 5 elements should be there. There should be buyer, there should be seller, there should be product or goods, and there should be a movement of consideration from one person to another person. Then only it is called as a sale consideration should be there. Then only it is called as a sale of goods. Otherwise, it is not a sale of goods. So in case of transmission of this, consideration is not there. Hence, it is not considered as a goods. Hence, does not require 188 compliances. Then in case of transfer of shares, it requires 188 compliances, because it is a goods. Gift also no consideration, whether it is considered as a goods or not, I already dealt with. Then, wherever this 188 is not applicable, but 177 is required to be mandatorily complied, because it is a related party transactions. We will deal with this later whenever we are dealing with this 177 related matters.
Excuse me. In transfer of shares, company will not be involved, right? Because
between transfer of shares from holding company to subsidiary company or one company to another company, there is a related party transaction.
in case the company is involved.
Companies are involved. Then another second related party transaction is selling or otherwise disposing of or buying of any property of any kind. So there is no clarity with regard to the otherwise disposing, whether gift is included, whether this auction is included, or mortgage is also included. There is no clarity. Then property, whether it is a immobile property or mobile property, there is no clarity. But property includes movable as well as immobile property as well. This is a second transaction. Then third one, leasing of property of any kind. Any kind means whether it is maybe leasing of mobile property or leasing of immobile property. Then leasing, whether as per AS 19, I think if my memory is right, AS 19, whether finance lease is covered or whether it is operating lease is covered. It word says only leasing of any property. So as per my opinion, leasing means it includes every finance lease or operating lease. All leases are covered within the definition of this leasing. Okay. Fourth one, availing or rendering of any services requires compliance of section 188. Any services means what? Whether it is a professional services or other than professional services, whether professionals are exempted from this 188 transactions. So word says any services, whether contract of services or contract for services are included. All included, because wording is any services. Now under GST law, corporate guarantee is considered as services, and then it is 18% GST or whatever percentage of GST is available. When it is considered as corporate guarantee is considered service under GST law, whether it is services requires under compliance of section 188, or corporate guarantee or loans or securities or giving a security to the another body corporate, whether it requires compliance of section 188 within the definition of the services. So all these interpretation issues are there. As per my opinion, there are some specific clauses are there, specific section is there. 185, 186 talks about giving a loan or guarantee or security. When specific section is there, this is a general section. As per interpretation of statute, specific section will override general section. We need not comply this 188. If it complies other provisions of the Companies Act, then it is sufficient. We need not comply this 188. This is all about loans, guarantee, security, or corporate guarantee which attract GST and all. Appointment of any agent for purchase or sale of goods or material or services or property. This is under old. It was called as popularly called as sole selling agents. SSA sole selling agents. Now we clubbed all sole selling agent 294A, 294AA and all provisions we clubbed under this provision in single provision. Sole selling agent. Agent, who is agent? So whether distributor will be called as agent or dealer will be called as agent or stockist will be called as agent or representative will be called as agent. It depends upon the terms and conditions of each agreement. If you have to go by case and study whether it is a sole selling agent or not. And another one, office or place of profit. Another one is office or place of profit in the company, its subsidiary or associate company. When you can call any transaction as office or place of profit, it says office or place of profit means any office or place held by director or other than director. If a held by director, if a director is receiving any amount other than remuneration, that it amounts to office or place of profit. Any amount other than remuneration. Any amount other than remuneration in case of director, it is called as the office or place of profit, deemed that he is holding office or place of profit. In case of other than director, overall other than director, individual or firm or private company or other body corporate, if they receive any amount, the wording is any amount, then it is considered as a office or place of profit, requires compliance of section 188 of the Companies Act 2013. What is this? It says such a related party appointment to any office or place of profit in the company, its subsidiary, associate company. If any person is holding office or place of profit in the holding company, it does not cover because the wording is in the company, in subsidiary or associate. Holding company is not covered in this particular transaction. If any related party is holding a office or place of profit in the holding company, it does not cover in this particular transaction. Okay. It says what is a remuneration? There is a remuneration definition under 2 subsection 78 of the Companies Act. It says anything way of remuneration over and above remuneration to which he is entitled as a director by of a salary, fee, commission, whatever your 17(3) perquisite, say income from salary, all that those definitions is covered in this section 2 subsection 78. Like what is office, what is place, what is profit, I have given some meaning. The word office or place of profit up to monthly remuneration of 2,50,000, it is a board approval. Over and above 2,50,000 per monthly remuneration, it is a shareholders approval. That is the prescribed limit. So to up to 2 lakh, not exceeding 2,50,000 is a board approval. Exceeding 2,50,000, it is a shareholders approval. The wording is monthly remuneration of 2,50,000. What do you mean by monthly? Whether those amount which accrues on monthly basis only we should include, or those amounts which are accrues on yearly basis, whether leave encashment it is accrues on yearly basis, or bonus it accrues on yearly basis, not monthly basis, or medical expenses whenever there is a incident or there the medical expenses employees are claiming it. Whether those yearly expenses are in event based expenses, whether we can include in this monthly expenditure or yearly expenditure is not included. There are some case laws are there. So wording is monthly, which are all the amounts accrues on monthly basis, salary which accrues on monthly basis only we should include. We should not include which are all the salaries accrual basis, accrued on the yearly basis we need not include. There are some case laws are there within this one. If you go for government notification and all, they will salary and all they will announce or disclose in the time scale basis. 1 lakh, -20,000, -1 lakh 20,000, -20,000, -1 lakh 40,000 something. If you take a approval based on the time scale, whether it requires approval of 188, once again whenever there is an increase in the remuneration, If there is no because my salary is 1 lakh. After 1 year, my salary is 1,20,000. Whether it requires again board approval or shareholders approval, as the case may be, depending upon the salary, or if at the time of appointment itself, if the time scale is approved, whether it requires it does not require approval of shareholders or board, as the case may be. It says there are some case laws are there. Time scale if already approved, then we need not within the increase of salary within the time scale, then we need not go for board or shareholders approval, as the case may be. If it is going beyond that time scale approval, then we should take approval of the board or shareholders, as the case may be, depending upon 2,50,000 or below or above. Then it says. Office or place of profit, holding office or place of profit in the company, in subsidiary or associate company. If I am holding a subsidiary company, office or place of profit, whether it requires approval of only subsidiary company or holding company or both. So there are some case laws are there which we should require to take approval from holding company as well as subsidiary company if you are holding office or place of profit in the subsidiary company also. I am taking sitting fee as a director. Whether it requires approval of shareholders or the board under 188, or whether sitting fee provision is specified under section 187, maximum 1 lakh per meeting you can take under 187. If I am taking sitting fees for each board meeting or each committee meeting under 187, whether it requires section 188 approval, all those conflicting provisions, whether 187 I should comply or 188 I should comply. All those conflicting provisions are there. If you are specific provision, as I told you earlier, if a specific provision is there, then general provision we can comply. Specific provision you can comply. 187 if you are making payment of sitting fees, then 187 is sufficient for compliance purpose. Okay. Appointment of a managing director or CEO or CFO who is a related party to the director, whether it requires compliance of section 188. If it requires compliance of 188 because it is a relative holding office or place of profit exceeding 2,50,000 shareholders approval, below 2,50,000 board approval, it requires as the case may be. Then I am an unrelated party at the time of appointment as a employee of the company. During my appointment, I became related party to the director. Whether it requires approval during the course of my employment, I became related to the related party, as per provisions. There are some doubts are there in the minds of professional whether I should take during the appointment. If the section says to be entered or to be entered, based on the interpretation, you can say that at the time of entering into employment only, we should take 188 compliances. During the course of employment, if any employee became related to the director, then we need not take. But however, 184 disclosure of direct interest, there is some provisions other we'll deal with this later on. What is remuneration, what is subsidiary company, whatever definitions are there, it is only copy paste of definition. What is remuneration, what is subsidiary company, when the company will be called as a subsidiary company. There are two clauses are there: control the composition of the board of director or exercise the more than one half of the total voting power. What is control, again definition is there. What is control? Again, a different topic in depth. You have to deal with the subsidiary provisions. These are all subsidiary related definitions only. This is underwriting of commission. If a related party, if a company is appointing underwriters for their IPO, if you are making payment of underwriting commission to the related party, then it requires compliance of 188, whether board approval or other than board approval, depend upon some threshold limits are there. We will deal with this threshold limit. It says subscription of any security or derivative thereof of the company. Security, what is security? Defined under Security Contract Regulation Act. We have to go by this security contract act definition. The definition we have copied and pasted here. What is the definition? Security definition. Section 188, subsection 1. It is all about 4 sentences. I think some 10 or 15 slides are there. Then under that, first provision is there, second provision is there. Only subsection 1 is main provision. Then subsection 2, 3, 4, 5 and all, it is all small sections. Only subsection 1 if you deal. Then 2, 3, 4 and all, it is only subsidiary sections. Subsection for first provision says provided no contract or arrangement in case of company having paid up capital of not less than such amount or transaction not exceeding such amount as will be preferred shall be entered into except with prior approval of the company by resolution. As I told you in the other slides, within threshold limit, board approval, exceeding threshold limit, shareholders approval. When exceeding threshold limit, we are talking about this one. It says either paid up capital criteria the company has to satisfy, or some transactions limits are there. Those transaction limits if we satisfy, then shareholders approval is mandatory. Now as of now there is no paid up capital concept is there, it is not there. Earlier it was there during the 2014, now in the year somewhere 2015 or 15 something, in the year 2015 they have deleted the paid up capital. Now it is based on threshold limit, is based on the either turnover or net worth concept. Now there is no concept called the paid up capital, even though section uses the word paid up capital, but the rules does not prescribe about any amount related to paid up capital. Then paid up capital, or it is a or condition, not ID condition. Either you can satisfy paid up capital condition, or you can satisfy turnover or net worth related conditions as it is. Either if you satisfy, then 188 is applicable. Then section uses the word for transactions. Section uses the word not exceeding such sum as may be prescribed. Not exceeding means what is the minimum or maximum? Maximum. But whereas the rule says 10% or more, or 10% or more of the turnover, 10% of the more of the turnover. Section uses the word not exceeding, but rule uses the words 10% or more. Rule prescribes minimum, section prescribes the maximum. So there is a contradictory or some drafting error will be there in this first proviso, but still we have to go by this first proviso in alignment with the SEBI LODR. SEBI LODR also 10% something is there. So in alignment with harmonious interpretation, you can say that 10% you can conclude instead of going by this section. So there is a contradictory is there. Okay. Here it says transactions not exceeding such sum. Transactions, which is a singular transaction. If a company is entering into a singular transaction with related party, whether it requires compliance of 188, or transactions, whether plural only it requires series of transactions only requires compliance of 188, whether single transaction does not require compliance of 188. Those interpretation issues are there. As per General Clauses Act, singular includes plural, plural includes singular, all those things. So transaction or transactions, even though section uses the word transactions, you can conclude that it is a transaction or transaction, singular, plural, all as the case may be, you can consider. Then, as I told you, there is no difference between contract or arrangement or transaction, all one and same only for purpose of compliance of section 188. Then whether contract is formal contract or informal contract, express, implied, all those whether email or penny correspondence, bills can be considered as a contract, bills can also be considered as a contract. We need not enter into some separate related party contract, even purchase order can be considered as a contract under Indian Contract Act 1872. These are all the threshold limits in case of sale, purchase, supply of any goods, material directly or indirectly through appointment of agent, 10% or more of the turnover, leasing of property of any kind, 10% of turnover. Below this threshold limit, board approval. Above this threshold limit, 10% or more, then board as well as shareholders approval is required. Then selling or otherwise disposal of any buying a property of any kind directly or through appointment of agent, 10% or more of the net worth. For other above 3 columns, it is a net turnover. For property, it is a 10% of net worth. So monthly, in case of office or place of profit, 2,50,000, as I told you, exceeding 2,50,000 shareholders approval, below 2,50,000 it is a board approval. Then in case of underwriting, 1% of net worth. So if a company is making payment of underwriting commission to the underwriter who is a related party under 276, then exceeding 1% you have to take a shareholders approval. Below 1% you have to take approval of board as the case will. These are all the threshold limits. Okay. There is an explanation under rule number 15. It is hereby clarified that limits specified in subclass 1 to 4 shall apply for transaction or transaction to be entered into either individually or taken together with previous transaction during the financial year, whether continuously I am purchasing some goods or materials, whether I should take individually 10% of turnover, or whether I should aggregate turnover, or I am a construction company, I am purchasing steel, I am purchasing cement, I am purchasing this stone also. Whether we should calculate 10% for stone separately, or cement separately, or steel separately, or can I club all steels all in one basket and can I calculate 10% is exceeding 10% or below 10%? There is no clarity under the law. It says only individual are taken together with previous transactions, or whether I am having a 5 related party is dealing with 5 different goods. For 5 into 5 is 25. Whether I should check 10% limit for each 25 transactions, or each related party, all 5 transactions can a club. All those issues are there. There is no clarity under this explanation to rule number 15. How we are practically calculating all listed companies and all, they are calculating goods wise related party wise. Goods wise related. If I am dealing with steel, then 10% you calculate of turnover. If a steel related business is exceeding 10% shareholders approval, below 10% it is a board approval. In case of cement, if I am exceeding 10% aggregate of 10% turnover, then something like that you have to calculate. Product wise, each related party wise, practically they are all listed companies are following this method. And some companies, there are some cases, there are some companies to avoid this limit and all, they may club all entire under one basket and they may try to avoid this 188. While doing the audit or while certifying the 188 under CAR and all, you should see whether they have taken a 10% limit, whether individually or taken together or entirely or aggregate, something like that. As a chartered accountant or professional, you should see whether board approval is taken properly or shareholders approval is taken properly, product wise and related party wise. So all those things you have to check while doing the audit. Okay. As I told you, 10% of turnover or 10% of net worth. What about in case of newly incorporated companies? There is no turnover, there is no net worth. How we can calculate this 10%? Or in case of negative net worth companies, how to calculate this 10% of net worth in case of sale or purchase of leasing of property? How to calculate all these things? There are some practical issues are there. Any answer? In case of newly incorporated companies, how do we calculate this turnover? There is a turnover definition is there under section 2, and there is a net worth also. There is a definition under section 2. What is net worth? What is turnover? It is all based on the audited balance sheet of the latest financial year. Here for newly incorporated companies, there is no audited balance sheet. There is no financial year and itself is may not be over. So how do we calculate in case of related party transactions in case of first year or negative net worth companies? How do you calculate? Whether it is a board approval or shareholders approval or no approval. Because no turnover, no net worth, hence no approval is required under 188. You can directly go to compliant, you can certify that it is a compliance with 188 and you can issue the CAR report and auditor's report under 143. Any answer for these two questions?
Better to take the permission.
Better to take a permission. It is as good as you don't have a net worth, it is exceeding 10% only. So it is better to take a approval of board as well as shareholders in case of newly incorporated companies or negative net worth companies.
I have a very kind of. There is a company got incorporated on 1st January and they hold meetings like 3 months once. So the transaction starts from 1st January to 31st March. So first board meeting within incorporation within 1 month they have held. So this board meeting is 30th April, for example. And this transition starts from the 1st February in that case.
Wait for another around 10 or 15 slides. All permutation combination permitted, so it is under law only is permitted. Then second proviso, first proviso talks about threshold limit. Second proviso, in case of related, if a member is related, then he cannot vote for the particular transaction. It says provided further that no member of the company shall vote on such resolution to approve any contract or arrangement which will be entered into by the company. Such member is a related party. It is a restriction on voting. So you can, if a other party is a related party, if he is a member, then he cannot vote for that particular related party transaction. So there is a en bloc voting restriction is there in this proviso. So there was a deadlock situation in the year 2014-15 and all, there was a deadlock situation. Then if you go to this related party definition under 276, there are around 28 related parties are there. If a company is entering into some contract with Mr. A and Mr. A is related to all 28 parties, then 28 parties themselves are not able to vote for this particular transaction, then who else can vote? There is a deadlock situation under the second proviso. Then if you read this subsection 1 and proviso combinedly interpretation and all, if you read no company, that proviso says no company shall, if such member is a related party, subsection 1 says no company shall enter into contract or arrangement with related party. If you combinedly read, then member who is a related party shall not vote. So there was interpretation is going on from 2014 to 2015. There was interpretation is going on. Some auditor says that no, you cannot, he cannot vote at all. You cannot do any related transaction. There was a deadlock situation. Then Ministry of Corporate Affairs has given one circular number 30 for 2014. It says that related party transaction. They have stated that prohibition apply only to the member who is actually related party entering into contract or agreement under consideration. It does not extend to any other member, even if they are also related parties. So they were given some relaxation in the year 2014 by circular number 30 bar 2014. So now all 28 parties are not related parties. With whom you are entering into contract, he is alone prohibited to vote for that particular transaction. Other parties, even though they are related, they can vote for that particular transaction even though they are related parties. That's what circular number 30 says, and that's what interpretation of statute. If you read proviso along with subsection 1, if you read combinedly, then it says we can read that a member who is a related party shall not vote. So not all related parties, only concerned member alone cannot vote. And the rationale is all, if 28 types of related parties were barred from voting, it could cause a deadlock in the RPT approvals. That's circular number 30 by 2014. Then in case of disclosure of direct interest, say that in case of private company disclosure of direct interest, he can disclose his interest and he can vote for the resolution. For other than private company, they cannot participate, they cannot vote. All those things it is there in 184 will be later. Then interested director, this is a second proviso, talks about member voting restriction. What about director? Whether director can vote for a particular related party transaction? Here is the answer. 15.2 talks about director must not present during the discussion or vote at the meeting. So either member should not, it's prohibition is for both. The director also is prohibited to vote. Shareholder is also prohibited to vote in case of related to the transaction if it is falling under 7 transactions as per section 188. Okay. I think you may be aware, as per section 47, every shareholder is having only one member, one vote, or one share, one vote. There is a concept is there. When one section says one member, one vote, or one share, one vote, how this section says you cannot vote? There is a contradictory between section 47 and section 188. How do we interpret this? Both one section says you can vote, another section says you cannot vote. So how do I comply this contradiction between this 47 and 188? There is some exceptions are there. In case of 188, which one will prevail over, whether 47 will prevail over or 188 is prevail over. So in case of related party transaction, 188 will prevail over 47. You need not comply 47. You can, if you comply with 188, all those. Then in case of partly paid up shares, I am having only voting rights with in proportion to my paid up capital. Whatever amount I paid, I am having only that much voting rights. Whether can I vote something like that, then which will prevail over, whether 50 subsection 2 will prevail over or 188 will prevail over. So the section talks about 180 will prevail over all 43, 47, 52. In case of 43, there are 2 kinds of shares are there, as you are aware, equity shares, preference shares. Under equity shares, equity with normal voting rate, differential voting rate. In case of differential voting rate, whether can I vote for this particular related transaction, because 43 differential DVR is there. DVR, I have a DVR with respect to related party, whether can I vote for related party when section 188 prohibited to vote for this one, which one will prevail over, then the section says 188 will prevail over 43, 50, 47. Then, in case of if all directors are interested, if all shareholders are interested, then how do we, there is a deadlock situation, how do we get a approval of the shareholders or board as the case may be. In case of all directors are related or all shareholders are related, then you can appoint non-interested director. In one company in the year 2014, in the year of enactment of 2014, we had this situation, all directors are interested, all shareholders are interested. How do we comply this related party transaction? Then we appointed disinterested director. Then we transferred one share from one interested member to other non-interested member. We transferred one share. Then we created disinterested quorum for board meeting as well as a shareholders meeting. Then those 2 shareholders and those 2 directors approved the related party transactions without the presence of interested member. All those things happened in the year 2014. Then ministry has understood this deadlock situation. Then they issued the exemption notification to private company. 5th June 2015 they have issued the exemption. In case of private company, they can disclose the interest and they can vote for the resolution, something like that. It is there in the 5th June 2015 exemption notification. That exemption notification, you can claim, all private companies, you can avail the exemption notification provided if you are not in default of MGT7 and DOSC for that is incorporated in their 13th June 2017 notification. They incorporated. If any company, private company is default of MGT7 and DOSC4 balance sheet and annual return, then they cannot avail this exemption notification. That is also incorporated in the 2017 notification. So you should see whether whether they have filed all companies are regular in filing MGT7 and AOC for annual return and balance sheet in time. After filing, if there is any default, then they cannot avail this interested party second provision. They cannot avail the exemption. Then they have to appoint non-interested directors or non-interested member. They have to appoint. Then they can get a approval from the disinterested director or non-interested member. Similarly, with regard to this exemption notification, you have to take care while certifying this, while issuing this thorough report. Deadlock situation. There is under Indian Contract Act, there is a doctrine of impossibility. In case of impossibility, whether we can take advantage of section 56 of the Indian Contract Act, all impossible actions can be considered as a void. For example, Iran and Israel war is there. I have made some contract. This contract I cannot be able to enforce because of war. So this is a doctrine of impossibility. Whether other party can enforce, you cannot enforce. It is called as a void contract. Whether the deadlock situation can be rely on this doctrine of impossibility under 56 of the Indian Contract Act. There are some case laws that the dogmatic principle, some case laws there under Supreme Court case law, whether can you rely on those case laws, and there are some interpretation issues are there. So you have to go through these interpretation issues in case of any deadlock situations. Okay. This is a summary of interested director, interested member. I have made some summary when we should not consider, when we should consider. In case of interested director, quorum you can consider him for the quorum purpose only for specific agenda item, not for all agenda item. If he is interested in specific agenda item, then you should not be counted for quorum. In other agenda item, you can consider for quorum. Participation, there is a difference between present and participation. So a member can be present inside the hall, he can participate. But because some sections uses the word he should not present. So he should not present means he should go out of the meeting hall. In some sections he uses the word participation. Participation means he can sit inside the board, he can present, but only thing he cannot participate. Those differences I made a table in case of interested member, in case of interested director, I made quorum, participation, vote, present, all this quorum. Now, there is some, it says, no member of the company shall vote on such resolution to approve any contract or arrangement which may be entered into by the company. One company has entered into transaction with the related party after approval of the shareholders. After 1 year or 6 months, they want to cancel that agreement by way of a shareholders resolution. Now, that interested member also casted his vote. Whether his interested member vote can be considered in case of cancellation of already approved related party transaction. Any idea? I told interested member cannot vote. But I am telling you in a different scenario. I have already entered into a related party transaction after approval of the shareholders, but I want to cancel that particular related party transaction contract or transaction or arrangement by passing another one resolution. For that particular resolution, interested member also voted. Whether can we consider his interested member vote, or we cannot consider?
Yes.
Yes, no.
The transaction itself is a void and null, so you cannot cancel.
No, you cannot consider it as void and null. They have approved. They have taken an approval with approval of the shareholders beyond threshold limit. Only thing they are not going to continue. They want to cancel now.
Termination.
For the termination, reciting that particular resolution, whether interested member can vote or not. So this matter went to Supreme Court. So Supreme Court has decided that the section uses the word entered into. It does not say that cancellation or rescinding. Every time this restriction of voting is applicable only in case of entering into transaction, at the time of entering into contract, not at the time of cancellation. So they have Supreme Court recently they have interpreted that at the time of entering into contract, not at the time of cancellation or rescinding that particular resolution.
But it will be given advantages to the person.
Sir, section uses the word. When loophole is there, you can take a use of the loophole. That's what professionals do.
What is the state of the contract?
You and me get a bread and butter only out of this loopholes of this wordings only, sir.
No, it is not the intention of the lawmaker.
Correct. But Supreme Court says then it is law of the land, sir.
See, case cannot vote in the meeting, but still it was done by voting. What is the?
No, at the time of entering, he has not voted. At the time of cancellation, he has voted.
Okay.
Sorry. Because the wording is to be entered. So entered, the wording, the Supreme Court has interpreted what is entered into.
Entered also includes exit.
That does not include what, that's what Supreme Court says. Then this is a third proviso. There is a in case of wholly owned subsidiary, in case of relatives and all, there husband and wife company, brother or sister company, there was a government thought that ease of doing business, you can amend this section. It says that if 90% of the members are relatives or promoters, then you need not comply this section. Second proviso, you need not comply something that the government has amended this one, 90% are more relatives and promoters, then we need not comply. Second rule, interested party, interested vote, interested member and all, you need not comply if 90% are more of the related parties. This is 188. 1 itself is not applicable if transactions or contract or arrangement is at fair market value and arm's length transactions. So the arm's length transaction means transaction between two related parties that is conducted as if they were unrelated. That is, there is no conflict of interest. There is a difference between these two words, arm's length transaction and ordinary course of business. If it is both are sections, both wordings are complied, then you need not comply section 188. You know already better than me what is arm's length transaction under 192 C of the Income Tax Act, the international transfer pricing, what is arm's length, what is ordinary business and all. I will tell you the exact difference. There is a difference between, in this word, it uses the word in its ordinary course of business. In the ordinary course of its business, what is the difference? The it places the major role here. In this section 188 subsection 1, 4 proviso says in its ordinary course of business, but in some other 185 section talks about in the course of its business. What is there any exact difference or 197 or 1956 Act? It is like 1956 Act is confusing beautifully and Companies Act 230 is beautifully confusing. Or beautifully confusing or confusing beautifully or one and same only. Either way, sir, it ulta patta ashte sir, ingenilla.
Confusing.
Yeah, based on these words, we can interpret and we can come out of this 180 or something like that. And when transactions will be called as arm's length transaction, when it is ordinary course of business, how it is ordinary course of business, whether it should be there in the MOA, whether it should be there in the main object of MOA, whether it should be there in the incidental object was also sufficient. Or one-time transaction is also sufficient, or series of transactions should be there. We should go by ordinary course of business or arm's length basis. We should go by case-to-case basis. We should see what is the terms and conditions. We should go by case-to-case basis, and we should study each and every fact. Then only we can conclude that whether it is arm's length transaction or not as arm's length transaction in the course of ordinary course or not in the course of ordinary course of business. In order to check whether 188.1 is applicable or 188.1 is not applicable, we should go by this. Each facts and each case of the depending upon each company. So, in order to take advantage of this 188.4 proviso, there should be ordinary course of business and arm's length transaction. If both is complied, then you can take an exemption of section 188 subsection 1. If 188 subsection 1 is exempted, whether all other provisions also exempted consequently, because 188.1 is substantive provision, 188.2, 3, 4 and all, it is a registers or voidable contract, unforeseen contract and all, whether one is exempted, whether all subsections are exempted, there is some interpretation issues are there. What is ordinary course of business? I already explained whether it should be there in the main object or whether regular conduct of business or carrying the business or it should be necessary in the directly or indirectly to incidental or ancillary to the main object of the company. You should go by each and every fact, then only we can tell you whether it is ordinary course of business or whether we can take as a arm's length transaction. How to determine ordinary course of business, I will mention around 8 or 7 cases based on, I think Caro also defines some parameters. I think this is copied from your Caro guidance note on related party transactions or guidance note on Caro defines each and everything needs to be complied, something like that. It is copied and pasted from your guidance note on Kara only. Ordinary course of business, whether it should be there in the object clause, whether it is a furtherance of business, whether it is normal or otherwise routine particular transaction, all the case-to-case basis you should go by. What is arm's length transaction? I think I need not discuss, you are more experts than me. As an income tax, domestic transfer pricing earlier it was there, now transfer pricing is there, cup method, whatever resale price method, whatever method is there to arrive this international transaction, arm's length principle. If it is exempted from 188.1, whether it is exempted for all transactions from a particular transaction or only 7 transactions or out of 1 or 2 transactions applicable, it says exempted from all contract, all transactions, all 7 transactions is exempted. If it is to prove that if it is ordinary course of business and arm's length transaction, then every auditor has to verify whether whatever related party transactions are there, they have to enter in the register maintained under 189. But if 188 itself is exempted, whether register is applicable or not, those interpretation issues I have mentioned here. It says 189 says every company shall keep 1 or more register, so and so and so. Whenever there is a 184.2 or section 188 applies, if a fourth price, if my ordinary course of business or arm's length, when it is not applicable, then whether I have to maintain this 189 register, you need not maintain 189 register because it is not applicable. I am appointing, I am a director, I am appointing my relative who is falling under related party transaction, related party list, whether appointment of my relative as an employee, whether it amounts to office or place of profit. If it is ordinary course of business at arm's length, whether it amounts to office or place of profit requires RPT, or whether can I take as an exemption considering that arm's length ordinary course of business. Whether recruitment of employees is ordinary course or extraordinary course is ordinary course. If it is market, if a market I am paying 50,000 rupees, I am paying same 50,000 for my relative, whether it amounts to office or place of profit. Whether can I take advantage of this fourth proviso to 188.1, all those issues I have mentioned here.
What is the question, sir?
Sorry, sir?
Because it is a salary basis, but the salary depends upon the person to person. So even we cannot take it out as arm's length price as a basis here.
So
The qualifications are equal, but it depends upon the person capable.
correct.
In that scenario, arm's length prices will be not taken into
Sir, it is a professional judgment. When in doubt, comply.
Come, first class.
I think 20 years or 25 years back only, I think it was Narayana Murthy sir has announced that when in doubt, disclose. Why you should take a risk? And it is only ordinary resolution, not special resolution. If it is 180,
314, no?
314, same replica only, sir. 2,50,000 replica only. 314 B and 314A, same, sir. Then, if it is exempted
They are
from,
asking for the taking of permission.
if it is exempted from 188, whether 177 audit committee approval is required, wherever audit committee is constituted, we will deal with this audit committee related later on. Okay. These are all whatever we discussed so far. It is a summary. Related party transaction at arm's length in the ordinary course of business in case of private company where the audit committee approval is required. Audit committee itself is not applicable, then audit committee approval, question of audit committee is not applicable. Then board approval, if it is arm's length ordinary course, then it is not applicable. Then shareholders approval, if it is arm's length at ordinary course, it is not applicable. Unlisted public company audit committee where specified unlisted companies are required to constitute audit committee, it is required. Then approval of the board, if it is arm's length and fair market value, then it is not applicable. Shareholders also it is not applicable if it is ordinary course and arm's length. This is not at arm's length, not in the course of ordinary course of business, then private company audit committee approval itself is not applicable because concept of audit committee is not applicable for audit committee. Then board approval is required, shareholders approval is also required wherever this 10% turnover or 10% of the network as we discussed earlier in the seven transactions list. Unlisted public company board approval, audit committee is also required to be approved this related party transaction. Shareholders also required, board is also required. I made that summary for easy understanding. This is the fifth proviso under 188 subsection 1. This is a recently incorporated and amended section. In case of holding company and wholly owned subsidiary company, there is a relaxation because the entire subsidiary company, entire shares were held by holding company only. There is no question of passing shareholders approval or directors board approval because of holding in subsidiary, because entire shareholding or entire voting power vests with holding company, and that subsidiary company's transaction, the related party transaction is holding company only. So there is a relax. There is no point in getting the approval of shareholders when the holding company itself is having 100% ownership with the subsidiary company. Government thought that there is a, let us give an exemption for related party transaction between holding company and wholly owned subsidiary company alone exempted, provided that they have given some conditions also. The condition is holding company enter into transaction to wholly owned subsidiary, provided subsidiary accounts are consolidated and approved at the holding company general meeting. Then only it is we need not comply with 188, otherwise 188 is applicable. Then company can be called as a wholly owned subsidiary. This is a crucial point. I think we filed a merger petition before RD. Nowadays mergers wholly owned, so this fast track mergers and all, they are not approving it, considering whether it is wholly owned subsidiary or not wholly owned subsidiary, because wholly owned subsidiaries alone are come under fast track merger. Other than wholly owned subsidiary not come under fast track merger. When company can be called as a wholly owned subsidiary. So as a professionals, you should understand, that normally entire shares should be held by holding company, but in order to maintain this minimum number of shareholders, 2 or 7 as the case may be, private company or public company, one share will be held by nominee shareholder. That nomination beneficial interest they have to declare. Unless this MGT4, MGT5, MGT6 declaration of beneficial interest is intimated to the ROC, it will not be called as 100% subsidiary. I think for income tax, under income tax provisions also there are some relaxations for wholly owned subsidiaries also there. When the company can be called as wholly owned subsidiary, only when section 89 MGT4, 5, 6 are filed for ROC, then only it can be called as a wholly owned subsidiary. So those things I think auditor's report or somewhere it is auditor has to report that all the investments are held in the name of company. Whether any investments are not held in the name of company, that is also required to be reported in the CAR or somewhere I read it. So in case of nominee shareholder, whether the company is not holding in its own name, the nominee is holding, whether it is permitted or not, all those things you have to take care of this part. Then condition is accounts are consolidated. When there are some cases, certain cases under Rule 6 of the accounts rules, consolidation is not mandatory. There is exemption or relaxation is there under Rule 6. If I am taking that relaxation benefit provided under accounts rules, whether still I can able to take advantage of this 188 fifth proviso, whether consolidation I am not able to consolidate, it is not possible. Only your accounts are consolidated holding company, only you can take advantage of 188. Otherwise, if you are taking advantage of Rule 6 of the accounts rules, then you cannot take this one. Then it says approved at the holding company and the general meeting. Now question is, normally balance sheet, I think normally the procedure of approval of the balance sheet is first the board meeting they will hold, they will approve the balance sheet, they will hand over to the auditor, and thereafter auditor will do the audit, and thereafter it will come back to the board, and thereafter it will reach the shareholders. Now question arises, who is approval authority? Whether board is approval authority or shareholders is approval authority?
Shareholder is the approval.
Any other different view? Because shareholder normally, if you see any of the annual report, the annual report first agenda says to consider and adopt. It does not never say or does not say any time to approve the financial statement. It says only consider or adopt. So always approval authority is vests with board of directors, because without approval of auditor or board, your auditor cannot do the audit of balance sheet without approval of the board.
So you can recommend.
Dividend is recommendation.
Correct.
But accounts is approval of the approval authority vests with board only, not shareholders. Because 134 uses the word approved. But whereas in case of the 102 explanatory statement, there are 4 business, ordinary business, special business. Ordinary business talks about 4 items. First one is adopt, consider or adopt. It does not say approval. But here section uses the word approved. So you can say that it's approved what can be considered as adopt and consider, adopt or consider, not approval. And it says always accounts approval is a matter of ordinary business. Ordinary business always you can consider at AGM, not at EGM. But section uses the word general meeting. So you can construe that, you can consider that general meeting means it is the AGM for the purpose of this provision, not EGM, because accounts cannot be approved at EGM, always accounts should be approved at AGM only because it is ordinary business under 102. So considering this 102, 240, 150, you can say that approval means it is considered as adoption or consider, and general meeting means it is always AGM, not EGM. We spoke about this beneficial interest declaration in order to call any company, any subsidiary as a wholly owned subsidiary, or MGT 4, 5, 6, then there is some register, is there MBP 3 register you have to maintain. If investment is not held in the name of the company, if held in the name of some other nominee, then you have to check, auditor has to check what is the register, and then those registers we have mentioned here. One 187 talks about investment should be all investment should be held in the name of company. Some exception. This is one of the exception. Nominee shareholder exception is there. This is one exception we have provided. What about newly incorporated company, holding company, subsidiary company, today incorporated? Tomorrow can I enter into a transaction without filing this MGT 45? Whether can I call myself as a wholly owned subsidiary? Those questions we have mentioned. This Rule 6 we already dealt with. Then consolidation exemption is from general meeting approval or board approval as per these wordings. Provided the requirement of passing resolution under first proviso. First proviso talks about shareholders approval. It does not talk about board approval. Board approval is mentioned under section 188 subsection 1. So first proviso talks about shareholders approval. So wholly owned subsidiary concept exemption is applicable only for shareholders approval. Still you have to take up approval of the board as per my opinion. That's what I mentioned. Consolidation exemption is from general meeting approval or board approval as well. These are all the exemptions. We already spoke to these exemptions. Holding company, wholly owned subsidiary, government companies also there are some exemptions are there. Unlisted government company, listed government company, there are some exemptions from 188 of the Provisions of Companies Act. Those things they are mentioned here. As I told you, in case of default in filing AOC for an entities on annual return and balance sheet, then you cannot take exemption from 188. You have to comply with 188 if there is any default. Whenever you are issuing an audit report, you should see whether last year annual return entities on AOC is filed in time or not, whether it is a file related or not. Whether filed or not at the time of issuing. If you are as of 31st March, if there is a default in AOC for entities, then you cannot claim this exemption under exemption notification to private company dated 13 June 2017. This is substantive provision is over under 188 subsection 1. Other than this, 2, 3, 4 under not much provisions. If any clarifications or doubts are there under 188 1, you can leave. Otherwise, we will go to 188 2. Any doubts or any clarifications? (188)(2) read with rules. Every contract or arrangement entered into under subsection 1 shall be referred to in board report to the shareholders along with justification for entering into such contract arrangement. Now, for every board report, you have to attach one form called AOC2. Now, 30th May, they have, I think next month, 14th or 18th onwards, MCA is going to be changed for annual filing. Now, till now, we are filing all balance sheet and annual return in E-form. Now, they are making web form from next month, 18th or 14th onwards. And along with AOC for MGT design, we have to file this. Now, all along related party transaction, AOC1 silent features of subsidiary or associate or AOC to related party transaction or CSR related CSR1 and CSR2 and all, we are used to file attachment. Now, everything we should file in E-form along with AOC for MGT design, we should file AOC1 E-form, AOC2 E-form and all. It is all web-based form from next month, 14th or 18th onwards. Along with this, now audit report also they made it web form. Audit report, required audit report, we should copy and paste it in the web form. Board report also they made it web form. So far, board report, audit report, and all used to scan and attach. Now they made it everything web form. I think web form easy for their data analytics. Artificial intelligence, they can use artificial intelligence. In case of E-form and all, they cannot do any artificial intelligence. In case of web form, they can do all these things and. Audit report, they have mentioned qualifications, board comment on auditor qualification remarks, or whatever qualifications are there, you should disclose, copy and paste in the extract of the audit report, extract of the BED report. There are some separate forms are there. Now annual filing is not easy. Everything you should fill in the web form. I think more than 20 lakhs or 25 lakhs companies, if at a time all people are logged into that particular website, then the website hacking issue may be there. Again, they have announced that some for annual report, AOC for and all, we will give you offline Excel utility and all. They have stated how this will work in the future after 18th, we don't know. We should wait for up to 14th or 18th to understand how this web form and all it will work. This is the format of the EOC2. This is notified on 30th May 2025. Earlier you used to file in attachment in a PDF format. Now you have to file in e-form, web form basis. This is the, there are two parts are there, not at arm's length transaction or not at arm's length transaction. Now we can say that when arm's length ordinary course of business, arm's length when 188.1 itself is exempted, why I should provide EOC2? And whether AOC 188.2 says every contract or arrangement entered into in subsection 1, whether subsection 1 itself is exempted, whether you should provide details in AOC 2, those issues of practical challenges. Some people are following, some people are not following. There is a diverse practice are there. You have to, depending upon your risk factor or safety, you have to take whether I should intimate or whether I should not intimate, because it says every contract. It says every contract. When 188.1 it is exempted, whether we need to disclose in the board report or I should not disclose in the board report when itself is when it is ordinary course of the Samsung transaction. There is a diverse practice in the market whether it should be used or not. Then the one AOC2 says AOC2 there are the two parts are there. One details of contracts or arrangement or transactions not at arm's length. Another one details of material contract arrangement or transaction at arm's length. What is this material arm's length transaction? Nowhere in the 188 or under rule there is no concept of what is the definition of material. What is material? What is not material? If it is not material, if it is at arm's length basis, if it is not material, whether you should disclose in AOC2 or whether you should not disclose in AOC2. All those things there is all judgment is involved. Those things are what is material, whether this 10% threshold limits, whatever they are prescribed, whether can we consider it as a material, and based on this, if you are below 10%, I can disclose in the AOC2, above 10%, I need not disclose, whether above 10% only, I can disclose in the AOC2. There are diverse practices are there. You have to, this is based on the judgment or opinion. And I discussed with some of the chartered accountants, they said that when company secretaries are there, why I should worry about this AOC2, and they are also talking like this. Why is cup of your tea, why you are posting to this question to me, when your company secretaries are domain is there, why I should talk about this AOC2 filing, and I will issue audit report, balance sheet, it is your headache, you do whatever you want. If something happens, then you face with it before the client, something like that. So a few friends of chartered accountants also informing these sentences. Now your question is answered in this slide, sir. So in case of emergency, what I should do? Today I incorporate, tomorrow I am entering into some contract. I cannot call board of directors because one director is in Singapore, another director in USA, another director in somewhere else. In your section says you cannot hold a board meeting, you cannot pass this RPT transaction circular direction. You have to call a physical board meeting, either physically or VC meeting. I cannot call. What I should do in case of emergency situation? This is the you can do ratification within 3 months. So the board approval within 3 months. Shareholders also there is a ratification concept is there within 3 months, and the audit committee up to 1 crore you can enter without audit committee approval. Within 3 months you can ratify. What if it is not ratified, then it is avoidable at the option of the board or committee or shareholder, as the case will be avoidable. Whatever they want, they can take a decision avoidable.
Excuse me, I have one question. You mentioned it's within 3 months. What if I am a small company and I have a requirement for only 2 board meetings?
You have to hold one board meeting specifically for the purpose of 188. Yeah, because by considering 173, every 6 months I have a time limit of holding board meeting. Yeah, it is a maximum limit they have prescribed, sir. But it does not bar you to hold a board meeting on every day basis also. Every day will get sitting fees. This is 188.4. If you are, if it is not, if it is a viable contractor, is there any violation of 188? Then who is responsible? The concerned director or employee, we can recover the money from them, and he is liable. Generally, for all, generally majority of the provisions of the Companies Act, in case of default, So there is a officer in default provisions are there under section 2 subsection 60, who is the officer in default, whether all directors are officer in default or only KLPs are officer in default. There is a section is there who in case of the violation, who is responsible for compliance, who is responsible for filing compounding application under 441 or education application under 454. So here is a different officer in default section is not applicable for 188. Only direct concerned director or employee also it is covered here. So employee also who is entered into this contract also is covered under 188. The regular officer in default, normally what will happen, if a MD is there, then MD alone is MD and company is alone responsible for compliances in case of default. If no MD, then company and all directors are responsible for compliances generally under 2 subsection 60. But here the 260 itself is not applicable. Here only concerned director, concerned employees are liable for violation of 188. These are all the penalty section. Listed company 25 lakhs, any other company 5 lakhs. This is only one penalty under 188. There are other penalties, other consequential or series of penalties are there. You cannot go by this only 188 penalty. There are series of penalties on the next slide. By not complying 188, there is a 130, 134 rate non-disclosure in board report. EOC2 needs to be attached to the board report. You are not attaching EOC2, then again these are all the penalties. Then if you are non-compliance of 177, if your audit committee approval needs to be required for certain transactions for certain companies, if you are not taking audit committee approval, if you are taking only board approval or shareholders approval, then 178 under subsection 180 there is a penalty is there. 184 I think earlier 22A form was there. Who are all my related parties? Every director has to intimate to the directors in 22A. Now it is called as a form number MBP1. If a form number MBP1 is not received, a director is not furnished this form number MBP1 every year, then the 184 there is a penalty is there. And contravention of 188, 167 vacation of office, 164 disqualification. I think statutory auditor has to report in his statutory audit report whether any director is disqualified under section 164. So there is some certification point is there under statutory audit report format under SA 700. There is a format. It is also included here. So if any contravention of 188, if any person convicted for contravention of 188, then 164 is applicable. 164 is deemed to be disqualified. Once it is deemed to be disqualified, is deemed to be vacated the office, then automatically you have to report in the your statutory audit report whether any director is disqualified under 164 subsection 2. Some clause is there in your statutory audit report format under SA 700. 164 on G disqualification, then you are not maintaining the registers properly. Then 188 register also related provisions are there. Then the ease of doing business, whatever penalty 5 lakhs, 2 lakhs, whatever penalty is there for small company, 1% company, startup company, producer company, it is 50% discount. So government is giving 50% discount to offer sale for Diwali sale or whatever Dasra sale. They are giving 50% for small company under 446 B of the company section 13. It is maximum of 2 lakhs, 1 lakh for each officer in default. 50% discount they have mentioned here. I am not dealing only 188. 188 is a small section, but I am dealing correlating with all projects of the company section 13, starting from 188, read with 184, 164, 167. So there are around 20-25 related provisions are there which are relevant for chartered accountants or company secretaries while issuing the report or while doing the audit. This is all about 188 related provisions. Now I am going with what and all related provisions are there so that you can link those provisions, because you cannot consider only 188. There are some linked provisions are there. We should know linked provisions also before doing any audit or before issuing any report. These are all the linked provisions. If any doubts or clarifications on 188, you can deal. Otherwise, you can go to next linked provisions. If any clarifications or doubts or questions under 188, you can deal. Otherwise, you can go to next slides. Next slide is 188 read with 260 read with 454. As I told you, for majority of the projects, the companies act, if any provisions are violated, then MD and company alone is liable wherever MD is there. If no MD is there, then company and all directors are liable. For this section, only concerned director and concerned employee is alone liable in case of violation. So it is now I think decriminalization of companies at 2013 they converted this offence from fine to penalty. I hope you may be aware of what is the difference between fine and penalty. It is converted and fine to penalty. Fine is a criminal offence, penalty is a civil offence. So they converted this criminal provision into civil provision from fine to penalty. So now if it is a fine, you should go for compounding. If it is a penalty, you should go for adjudication. That is the main difference. And fine is always a criminal offence. Penalty is always a civil offence. And fine always it is levied by the court or its quasi-judicial authority. Penalty and all it is executive power of the ROC. ROC, if you file before education application before ROC, he will only levy the penalty. You should, while doing the audit on case of related party transaction, whether you should see the board meeting agenda item and minutes. You should also see if it is more than threshold limits. You should also see the general meeting. There are some mandatory disclosures are there in the board report, board meeting agenda and general meeting agenda. These are all the mandatory disclosures as per. It should be disclosed in the minutes of the meeting and the agenda of the meeting. Board in case of shareholders meeting as the case will be depending upon the threshold. These are all the disclosures you should provide mandatorily in the agenda item of board or explanatory statement as per 1 or 2 in case of shareholders meeting. These are all the disclosures you have to provide. So this is the definition, very lengthy definition of a related party. Director or his relative. If a company is entering into transactions, the director, I think now it looks like 7 or 8 points. If you calculate this one, it will be more than 25 or 28 people. If 2 directors are there, then company plus 2 directors. Relative, husband, relative, there is a definition is there. Let us assume that only husband, wife, father, mother, the 2 children are there, then director, 2 directors, then father, mother, one each director, father, mother, all those husband, wife, brother, sister, all those 5 plus 2, 7. So it looks like on a very big list. So here it looks like only simple relative definition. But if you really calculate, each director will have around maybe around 5 or 10 direct relationship. If a company is having 2 directors, then it will be like 25 or 28 or 30 or 40 list. Then you clear. So director or his relative will come back this definition. What is the relative definition? Under old law there was 26 relative definitions are there. Now only around 4 or 5 definitions are there. Then key managerial person or his relative. So key managerial person, there is a definition under definition provision. Managing director, whole-time director, CEO, CS, and CFO are called as a key managerial person, and his relative is also covered. Then firm in which director or manager or his relative is a partner. Private company is director or manager or his relative is a member or director. It is a very vast definition. In public company in which director or manager holds director holds along with his relative more than 2% of the paid-up capital. Earlier it was aimed, they found some lacuna and they made with some issue of removal of difficult order, they made it as a aimed instead of or. Then any body corporate whose board of directors, managing director, manager is accustomed to act in accordance with the advice, directions, instructions of director or manager. It is nothing but our dummy director, shadow director, whatever, remote control director, whatever you can call in the general colloquial language, whatever. This is nothing but whether professionals should be called as a in a professional capacity as a chartered accountant or company secretary or as an advocate. If I am giving some advice based on my advice, if they are taking a direction, if they are taking decision whether it amounts to related party transactions or not, there is a clarification is there in the section. In your professional capacity, it does not amount to related party transactions. Then any person whose advice or direction, instructions, director, account should act is nothing but remote control director or whatever, dummy director or shadow director, whatever you can call. Any company which is holding company, subsidiary company or associate company of such company or subsidiary of a holding company to which it is also subsidiary, something that it was inserted recently. All definitions holding subsidiary related to the transactions were not covered earlier before amendment. They thought that there is a lacuna in this in the related party list. They amended, they included that holding and subsidiary between any related party transaction with holding and subsidiary company is considered as a related party transaction. They found that there is a lacuna in the related party definition. They amended and they included this one. But however, for ease of doing business, for private companies, it is whatever related party transaction between holding and subsidiary or associate company is not considered as a related party transaction. wide exemption notification dated 5th June 2015. Then any other person as will be prescribed, they have prescribed only one relationship so far, that is director other than independent director or key managerial person of holding company, his relative with reference to company shall be deemed to be a related party. In the rules they have prescribed this another relationship also. Then proviso, as I told you, professional capacity, if you are doing any advice or direction, then it is not considered as a related party transactions. Related party transaction is exhaustive definition, it is not an inclusive definition. Whatever specified only alone or related party transaction, whatever it is not there, don't include it. It is an exhaustive definition. It says with reference to company, it does not talk about body corporate and all. Body corporate. Now another question, it says director, key managerial person or firm. Now I am having question whether if a company is doing some related to the transaction with LLP, whether it requires compliance of 188, whether firm includes LLP or firm does not include LLP. As per Income Tax Act, firm includes LLP, but Income Tax Act is my neighbor house, my house is Companies Act, whether it includes firm includes LLP or not. Yes or no? Because there is no clarity in this one. Only Income Tax Act says firm includes LLP. Only in the auditor chapter it says for the purpose of auditor chapter firm includes LLP, because you can practice your practice in the name of LLP. Only for there he has clarified for the purpose of this chapter. This chapter is auditor chapter. But here he has not included firm includes the LLP or not. Here there is no clarity. It should, there is no clarity, then you should rely on interpretation of statute, purpose interpretation, what is the intention, and you should go by that decision. How we can conclude that accustomed to act, I have given some points. Accustomed to act when you can call as a shadow director or dummy director or remote control director in colloquial or normal language, not in a legal language. These are all the instances. You cannot. There should be some evidence to show that you should establish the evidence that a board is accustomed to company accustomed to act in accordance with the directions of some relative or director or somebody. You cannot take a decision, isolated decision, and one transaction you cannot decide. Series of transactions should be there to decide. All those things I have mentioned. What is accustomed to act. This is all about the 5th June notification in case of related party transaction between holding company, subsidiary company, associate company. It is not considered as a related party transaction for private companies. For other public companies and all, it is still you have to comply this 188 transactions. Okay. Whether if a company is entering into a related party transaction, director, KMP of a subsidiary or associate of fellow subsidiary, whether it is a related party transaction, whether if I am a company is carrying on some related party transaction, the promoter of the company, whether it is a related party transaction, those still those interpretation issues are there, because the relative definition does not cover promoter, does not cover director or KMP of subsidiary or associate of fellow subsidiary. It covers into holding a subsidiary company directly, but not with the holding. So director or KMP of holding company or subsidiary company, fellow subsidiary, something is there. You can take advantage of this one also. What is definition of relative? He has provided definition. Earlier under old law there was some schedule was there under schedule 26 or 28. All that flowchart, big flowchart used to come to our picture. Now they have simplified it. They are also come to this ease of doing business or simplification of relative definition also. It covers only HUF, husband and wife, father including stepfather, mother including stepmother, son includes stepson, son's wife, daughter, daughter's husband, brother, stepbrother, sister. So in nuclear family, he made it nuclear family instead of earlier joint family. No. So it is a exhaustive definition, not inclusive definition, because you cannot include whatever things you want. It is only restricted to these alone. Brother wife is not a relative because it does not cover brother wife. Sister's husband is not relative. If you are entering into, I think strange, but still you can consider because it is in the definition. I am talking about this one. Okay. Stepdaughter is not a relative.
and all other relationships are not relatives. I think some few of the agreement it says blood relatives. So blood relatives and whether if my blood is B positive and his blood is B positive, whether I am blood relative, I don't know what is that blood relative. Some agreements and all, I used to see these agreements blood relatives. Whether B means whether it is a blood relative, but other or whether I should take out my blood and inject in his blood, when I should become blood relatives. I don't know what is the definition. And now we are going by this rule-based definition only. If in case of Mukesh Ambani, Anil Ambani, if a Mukesh Ambani company and Anil Ambani company is entering into some transaction, even though they are whether talking terms or not in talking terms, but section says you have to take approval of shareholders. So it is a rule-based definition, not this actual this one. I had given some questions. Transaction between subsidiary X Limited has two subsidiaries, one in UK, another in US. Both subsidiaries are related to X Limited. Two subsidiaries have transaction among themselves, which gets consolidated to X Limited accounts. Any board approval of X Limited is required. So as I stated, whether there should be company with 7 transactions, then there should be related party. If between a subsidiary company, then I am not related. It is not a related party transaction. A company A Limited holding 49% in B Limited, both companies have common director. B Limited pays a commission to director. Is it a related party transaction? No, because it's not a transaction between A Limited and director. There are some few examples I have provided here. What is turnover definition as per section 2? What is network definition? It is copied and pasted. You can see from your section 2 of the Companies Act 2013 also. This is all about 188 related. Caro report says auditor has to report compliance of provisions of section 177 and 188 also. So all along we discussed about 188. Now we have to discuss about 177. What is 177? Because you have to state 177 as well as 188 also. 177 says every audit committee is not specified for a private company, only public specified public companies only it is applicable, not for all public companies, only specified public companies. So every audit committee shall act in accordance with terms of reference specified in so and so. Then approval or any subsequent modification of transactions of the company with related party. You can see the difference here. 188 uses the word related party transaction, but here uses the word transactions with related party. So there is all along difference is there. That reference all along we are calling 188 as a RPT, but 177 for classroom discussion, not for approved abbreviation. For within this 4 wall you can call it as a TRP, because if you tell outside and TV people will blame us. So TRP means transactions with related party. RPT means related party transaction. So all 188 transaction, 188 RPT transaction requires audit committee approval, whereas all transactions with related party does not require 188 approval. That is the main difference between RPT and TRP. All RPT require 188 as well as 177, but all TRPs may require and may not require 188 approval. That is the main difference between these related party transactions and transactions with related parties. And if your transaction with employment related contracts and all, it requires 177 as well as 188 as well as 178 the nomination remuneration committee meeting approval. So it requires all 3 sections approval we require by holding the NRC meeting, audit committee meeting, board approval in case of threshold and shareholders approval also. These are all sections, same copy. The audit committee may take omnibus approval in case of urgency, in case of regular repetitive transaction with justification. You can take omnibus approval subject to some conditions. We will deal with these conditions prescribed under 6A. Then in case of transaction other than referred in 188, where audit committee does not approve the transaction, it will make its recommendation to the board. In case of wholly owned subsidiary, whatever we learned in under 188, same thing is applicable for holding company, wholly owned subsidiary company. There is a relaxation provided under 177 by amendment of the Companies Amendment Act 2017. Audit committee, auditors of company and key management person shall have a right to audit the meeting. I think you may be getting some audit committee notices for attending the board meeting. So there they will ask whether the arm's length transaction 188, 177, all these compliances your board of directors will
ask auditors, whoever is present at the audit committee meeting, you are having a right to attend, and company is having a right to call for the presence of statutory auditors before the meeting. That's what 177 subsection says, or 7 also says. Then 146 in case of AGM, statutory auditor is required to attend AGM unless it is exempted by the company under 146. All those things are also in AGM. Shareholders can ask statutory auditor whether it is arm's length or not at arm's length, whether it is in compliance 188, whatever question they are having, they can ask, and the auditor is bound to attend this meeting unless it is exempted by the company, and bound to answer these questions related to equity-related transactions as per 146. This is omnibus approval in case of a repetitive transaction. I need not go to audit committee approval again and again. For repetitive transactions and all, you can take omnibus approval. One is a regular approval, another one omnibus approval for repetitive transaction. One is post facto ratification. Ratification we already discussed. Within 3 months you have to take a ratification method within 3 months. Transactions which require approval, repetitive transactions, and with justification you can. Audit committee can give approval for 1 year, whole 1 year. You can take approval for repetitive and justification in the interest of the company, in the interest of the members. They can give approval. One-time transaction which are backed by contractor agreement, we need not take approval. We need not take omnibus approval. You have to take a regular approval. That's what stated in this slide. And when you should take a omnibus approval, whether can I take in the middle of the year along with balance sheet approval, whether at the end of the year can I take all these questions are there. Then considering the transactions are valid for financial year, ideally it should be before start of the financial year or before initiating the particular transaction. You should, company is required to take a omnibus approval. As a statutory auditor, whether you should see whether omnibus approval they have taken for whether it is a repetitive transaction or one-time transaction. If it is one-time transaction, then you should insist that it is violation of 177. Whether you should qualify in your report, CARO report, 177 complied or not complied, 188 complied or not complied. All these things you should report in your CARO report with qualification, without qualification. Those qualifications also you should separately file in now from next month 14th or 18th onwards. Extract of audit report in web form separately. All these qualifications of 177, 188 separately as per CARO report. Omnibus approval. What is the process of omnibus approval? And name of the party, nature, duration of transaction, maximum amount. All these things you have to provide. Then in case of unforeseen transaction, only 1 crore you can do omnibus approval. In case of foreseen transaction, you can do more than 1 crore. Unforeseen transaction is valid for only 1 year. And in case of sale or purchase or disposing of undertaking, omnibus approval you cannot do. It has to be taken on a regular approval, not an omnibus approval in case of sale or disposal of undertaking. This is our ratification mechanism we already covered in others. Within 3 months you have to take a ratification. You have to take audit committee approval, otherwise it is viable at the option of the company. A register related, you have to maintain, every company has to maintain a related party register under, it is nothing but earlier 299 register, popular 299 register, now it is called as a 189 register. All contractor arrangement, MB24 register, extract maybe anybody can take extracts, copies may be furnished, the inspection can be done. Then these registers, every AGM we should place before the shareholders. AGM members can inspect these registers. Exemptions up to 5 lakhs related party transaction need not enter in the register. Whether they have entered in the register or not, you can see. Then very important as an auditor or as a company secretary, all this register entry, once it is entered, once it is entered in the next board meeting, they should place before the next board meeting. Whether they are placed before the next board meeting or it is there in the place before the next board meeting, and it should be signed by all the directors. Earlier also it was there. Now also it is there. Whether normally authentication or signature by any one authorized director is required, but under 189 register it should be signed by all the directors of the company who has attended that particular board meeting. All director has to sign, and it should be placed before the next board meeting compulsorily. 188, how it is linked with 134 AOC2, we have to attach AOC2 to the board report. All the AOC2 related we already discussed in the earlier sites. 177 subsection 8 audit, whichever audit committee has not approved any related party transaction, then the board report separately, whatever recommendation not accepted, they should disclose the board report. Those things we have mentioned in this 177 subsection 8. 184 disclosure of director interest. Whenever director is interested, they should not participate, they should not present, they should not vote, all those things. If it is holding more than 2%, they should not vote, all those things we have covered here. If they are voted, then it is a wordable contract, they should not participate. And whenever they are participating, if they are participated and voted, then it is a wordable contract at the option of the company. All those things, so 184 to read with 188 we are covered here. One 184 is exempted for certain companies, private companies, Section 8 companies, specified company. 188 interested director can vote after disclosing his interest. That's what we learned in second provision to 188. 188 read with 164 we already covered. Disqualification of director company. If any company violated the provision, convicted, if any person is convicted for offence under 188, then he is disqualified. Once it is disqualified, then vacation of office 167. Then audit report you have to certify, you have to disclose and certify that no director is disqualified under 164, 164 subsection 2, something like that. That is also covered in this one. 188 read with 167, 188 disqualification, vacation of director. Combinedly you should read. Here accounting standard, as I told you in the initial opening remarks, the only flowchart is there. I am not going to deal with accounting standard because you being the domain experts, it is not fair on my part to deal with accounting standard before chartered accountants, being a student of chartered accountant. Accounting standards, accounting standard 133, AS18, NDS for auditing standard, internal auditing standard 18 and 550 under 143. Now recently, in my client, I got ROC notice from one client stating that there are around, I am a director in 30 companies or 20 companies including company and LLP. I am having a related with transactions with 2 companies only. I don't have a transaction with all other 28 companies, only 2 companies. The company includes LLP, firm and all. Whether I should disclose all 28 company lists in the balance sheet or whichever company I am having transactions, only those companies only I should disclose. Any answer? Or whether irrespective of transaction I should disclose where if I am once I am filing under related party list under 276, read with your accounting standard.
List of related party what it has been used. So you have to disclose all the
Whether transaction is there or not during the year. That's what your accounting standard says. Accounting standard says same question is there, whether list of all related parties you should disclose, irrespective of whether transaction is there or not. So you should disclose everything. Whatever 2 subsection 76, 78 list is there, it is only minimum list. I think some more list is there under your accounting standard. He has structured the definition of related party under accounting standard 18 or 24 as the case may be. 188 read with 135, read with schedule 3, read with 180. If I am in case of CSR companies, if I am donating CSR expenditure to the trust, where all trustees are directors. Same common directors, common trustees. It is a common in case of a big conglomerate and all, it is a common, they will incorporate one trust and they will do all charity work through that particular trust. If a company is donating all their CSR expenditure or routed through this trust, whether it requires compliance of 188 or only 135, or first of all, whether it is permissible, can a related party transaction between company and trust, CSR related party transaction, whether it is permissible or not? I don't know, I am a student of chartered accountant. I think you esteemed professional has to teach me. These questions I covered. I think you can take a rely on this. Schedule 3 was amended in the year 2021 also, Schedule 3. In the Schedule 3 now, every CSR company has to disclose in the notes of account, some table is there, what is unspent and all. There he has given trust related matter, one sentence is there. So from there you can take that, you can give a CSR related provisions, CSR related expenditures. But even though it is a related party as per accounting standard, it is not a related party transaction as per relative definition, because relative definition does not cover a trust, but it may be covered under your accounting standard number 18 or 24 as the case may be. You have to comply those related party provisions under as per accounting standard, not as per 188. Then Schedule 3 notes upon some CSR disclosures are there. In, loans to related parties. The heading or title of this session is a regulatory framework under Companies Act 2013. So companies are 230, not only 188, there is a related party loans and other advances in case of related parties. You should see whether any related parties are not. Then loans and advances, you should see it out of the slide, deemed dividend 220 TU, whether loans and advances, accumulated profit, deemed dividend, all those things you can see this out of this related party loans and advances from or to related parties. Then in case of sale of undertaking more than 20%, 180 is applicable, 180 special resolution, ordinary resolution as against 180 is applicable. If it is sale of undertaking to related parties along with 188, you should comply this 180 as well as 188. If it is sale of undertaking for issue of shares or consideration other than cash, non-cash consideration, then along with 180 you should comply 182 as well as 188. All those combinations will be applicable in case of a big conglomerate. And 188 read with schedule for code of IDs. I think many chartered accountants or company secretaries are independent directors in some companies. It is as per the code of independent director, as per schedule number 4. It is a duty of the independent director to ensure that adequate deliberations are held before approving the related party transactions. In fact, it is not only independent directors, every director duty to ensure related party transactions are adequately deliberated and in the interest of the company, in the interest of the members. Under 166, under old law, there was no duty of the director specified under old law. Now, duty of the director, there are some duties are there with respect to the related parties. These are all the duties. If any director is taking undue advantage or gain, then it is a violation of section 166. Section 166 violation, there is a penalty or something is there. So it is read with 188, read with 166. 188 read with 192. In case of cash transaction, 188 is applicable. In case of non-cash transaction, 192 is applicable. I think Caro report talks about auditor certification and non-cash transaction under section 192. In case of any transaction, if you are issuing shares consideration other than cash, if you are purchasing some asset under 182 is applicable. Auditor has to certify whether it is a compliant or not. So 192. In case of non-cash transaction, valuation is mandatory. For valuation, it should be valued from the registered valuer. Who is the registered valuer? It is specified under 247. Whatever under 192, whatever we learnt under definition section under 278, it is not applicable for 192. It is altogether different definition. It's a different definition because it says some other wordings. Under 192, the definition is altogether different compared to 188 to read with 278. We analyze what is that 182 wordings and all. These are all the disclosure requirements for statutory auditor. Caro 2020 is applicable for secretarial auditor, MR3, secretarial audit report or MGT8 in case of 92 subsection 2 is company. Cost auditor, they have to certify in case of related party transactions. He has to certify in the CRA3. The CRA3 records of cost audit, it should be filed for ROC in CRA4. He has to comply with company. AOC2, as we discussed, MB4 register, they have to disclose. And the director every year, he has to, in the first board meeting, he has to give a MB1 earlier 220 form, similar to that form. MB1, whenever there is any change, he has to give intimate to the company, revise MB1, something like that. MB1 under 184.1, he has to disclose. And 188 read to SS1 now, SS1, SS2 made mandatory for all the companies. SS1 is secretary standard and board meeting, SS2 is secretary standard and general meeting. Under SS1, SS2, there are some additional disclosures are there for compliance of related party transaction. Those paragraphs we have stated here, 3.2, 5.18, 7.2.2 something, those paragraphs SS1 relating to board meeting, SS2 relating to general meeting. IT Act, as I told you, the opening remarks for excessive payment is also considered as a related party. And in case of trust and 13.3 related party, 13.13 something is there in a related party, you are the better person to decide about the 13.3 ADI or IA. As I told you in the opening remarks, any company borrows consortium loan of more than 5 crore every 6 months, September and March, where the chartered accountant or company secretary has to issue due diligence report to the company, company internally issue to the, will submit to the bank. So in due diligence report also there is a clause under clause number 4 whether RPT transactions are compliant or not under 180, 177, 188, all those things we have to certify and issue the due diligence report every 6 months. These are all question and answer. Only transactions covered in 188 are all transactions with related party needs approval already. Audit committee, as I told you, related party transaction or transactions with related party. These are all the questions. I think allotted time is 8 o'clock. That's why I was running. But now it is 7:53. I have a time of 7 minutes. If any questions are there, you can discuss. Otherwise, we will deal with these questions.
Audit fee is not paid, will it amount to related party transaction?
So if it is falling under 278, you are related party. You are prohibited under disqualification of auditor only. Auditor fees is not a related party transaction. If you are a related party, then how can you appoint as an auditor of the company? You are giving consent letter and not disqualified under 141 or something. Under code of ethics, schedule number 1, part number, schedule, there are 2 schedules are there. Under part 1 also it is covered under the class number 4 of your schedule also. Under Tata Accountant Act, schedule 1, schedule 2, schedule 1, part 1, class number 4 also it says. If my memory is right.
And it's not an independent auditor.
Independent. It is a dependent auditor. It is prohibited.
So if a private limited company, a member owns more than 80% and he is getting salary, it comes under related party transaction.
Sir, obviously it is there under he is covered under he is employee.
He is employed, yes. He is getting salary, but he is not a director.
If it is falling under 2 subsection 78 related definition, then it is amounts to office or place of profit. 272 subsection 78 related definition you should see. If it is falling, then it is amounts office or place of profit. If it is more than 250, monthly remuneration, shareholders approval. If it is less than 250, it is board approval.
Sir, my question to you is in the context of a Section 8 company.
Yes, sir.
In case a Section 8 company is paying remuneration to the director and the remuneration paid is it's very high, disproportionately high, I would say. In such a scenario, if the justification that the company has given is that it's board approved and also budgeted, in such a scenario, how would you evaluate from the propriety and compliance perspective?
Those remuneration, direct remuneration is not at all falling under 188.
Okay.
That is one thing. Second thing, I think under income tax act also you cannot pay remuneration 13(1) or 12 something registration they might have taken 12(ATG). You cannot pay excessive remuneration to the directors or trustees as the case may be, something is there.
Yeah, but because director comes under related party.
Correct.
So the question what I had is how do you evaluate such a scenario? Because as auditors, when we question them and they provide an explanation stating that it's budgeted and board approved, and also Section 8 companies being not-for-profit organizations, from the propriety aspect and the compliance perspective, how do you evaluate such a scenario?
You should disclose this fact to them. Because propriety concept, I don't think it is applicable for companies that own 30, it is applicable for C&H related matters. Propriety aspect, they will look into it. C&H will look into it to proprietary aspect in case of government related companies. For private company, public company, you are the better expert whether proprietary aspect is considered while doing the audit.
So disclosure is
This
something
you can
that-
disclose, you should disclose in order to take a precaution.
Thank you, sir.
Section 276, partnership firm is covered. How about proprietorship firm?
Sir, director.
Direct of the director. No, he has separate entity. He is providing some other service to the company.
Sir, PAN number is same. PAN number is same. Sir, you should see purpose of this incorporating this section. Purpose interpretation you should see. Otherwise, you should take a risk and certify. Tomorrow, if a disciplinary committee or some other committee issues notice, you can be able to justify. And by protecting client, by taking a risk from your side and by protecting client, we cannot get anything. He will not increase your fees, he will pay same fees by taking a risk also. If time permits, then I can go through this another 4 or 5 questions. I think maybe 10 questions are there. Otherwise, I leave it to the chairman to the. Only transactions covered because it is already 7:50 2 minutes are there. Now, only transactions covered in 188, all transactions coordinated needs approval of audit company in case of unlisted company. As I told you, the transactions related party transactions, there is a difference is there. So all transactions requires audit committee approval. Whether sitting fee for director attending board meeting, committee meeting require 177 as well as 188, 187, all those things. Sitting fee is not a related party transaction of 188, but however sitting fee is a related party transaction of 177. It requires 177 approval as well as 187 schedule 5, all those approvals it is required, but it does not fall under that 7 transactions list. I am a director as well as I am a company secretary, or I am a director as well as I am a CEO for being a chartered accountant. I am drawing the remuneration as a CFO, not as a director. Whether I am holding office or place of profit require under 188 approval. If I am drawing the remuneration as a director, not as a CFO, whether it requires 188 approval. I hope you are understanding the question. In one case, I am drawing remuneration in the capacity of CFO. In another case, I am drawing remuneration in the capacity of director. In which case, whether 188 board approval or shareholders approval, as a case will be depending upon the remuneration it requires.
Salary requires the board approval.
Sorry?
Salary requires the board approval. Remuneration to directors is not.
Salary remuneration is one and same only, sir, because remuneration is inclusive.
Remuneration covers under different section, no?
But remuneration salary is all anything by of remuneration or otherwise a remuneration definition. So my understanding, if you are drawing remuneration as a director, remuneration salary as a director, then 188 is not applicable. As a CFO, if you are drawing, then 188 is also applicable by stating that officer holding officer place of profit more than 250, less than 250 as a case, you have to take care of approval. As I told, whether issue of shares preferential transfer, buyback, declaration of dividend, all those related party transactions, it is not related party transaction 188, it may be related party transaction as per your accommodation number 18 or NDS 24 as the case may be. Whether transactions involving more than 1 crore cannot be ratified or something like that, I told up to 1 crore you can ratify, after 1 crore whether board can, whether audit committee can ratify, there is no answer for this one, it is all based on ratification or it is a violation of provisions of 177. Can a transaction that exceed omnibus approval limit approved by audit committee be ratified? All those complicated issues I posed a question before August audience. It says if property, whether property includes sale and purchase of trademark rights or IPR rights or patent rights, it says property includes everything. Does leasing include franchisee agreement or franchisee? It includes franchisee agreement also. The non-executive director receive commission on profits or sitting fees, expenses, attending board meeting, whether it is considered as RPT, it is not considered as RPT, it is considered a transaction related party requires some submission approval, not 188 approval. These are all some questions we have framed. Provision not applicable to corporate restructuring, amalgamation, merger, and 188 is not applicable because of the minister has issued on circular in the year 2014, circular number 30, it is not applicable. I think the relevant cases are Gensol, you are already aware, Gensol, what happened, Gensol, W Smart Taxi or Gensol, there is no related party compliances with regard to the Gensol related matter. Those things we have discussed in this case. With this, I think, end of this session. If any further questions are there, I am happy to answer. Otherwise, we will leave the floor to our chairman and office bearer for further proceedings. And once again, I thank for opportunity and thanks the chairman and other office bearer for inviting me to be share with our knowledge on 188 of the company that is protected. Thank you.
Good evening and namaste members. It is my honor to extend heartfelt word of thanks on behalf of Bangalore branch and members present here. We are immensely grateful to CS Vijay Kumar Sajjan for taking the time to enlighten us on the crucial topic of the regulatory framework for the related party transaction and insight under the Companies Act 2013. Your deep understanding and comprehensive analysis on such a complex subject has not only enriched our knowledge but also provided clarity on the implication and significance of these regulations in today's corporate landscape. Sir, we appreciate your dedication and enthusiasm in sharing your expertise with us today. Let us give a warm round of applause to CS Vijay Kumar Sajjan for his outstanding deliberation. Now I call upon CM Manjunath Halur, Chairman of Bangalore branch, onto the dais to present a memento to the speaker as a gratitude and respect on behalf of Bangalore branch and the member present here. Thank you, Chairman, sir. Thank you, member. We have one small announcement. Half-day seminar will be organized till 30th of June. Whoever has not completed CPRs, kindly do register for the events. Thank you.